With interest rates raised 3/4 percentage points, we want to know what this means for our finances.
And here to break this down a little bit more for us, we have financial advisor David Reyes from Reyes Financial Architecture. Good morning to you, David.
Good morning to you.
Glad to have you with us. So, okay, prices have been so high. We know this inflation. We've all been living through it. People have been spending their money, though. And now with this rate hike, is it going to do what the Feds are hoping it does and actually lower our prices?
Yes, I believe so. I mean, you'll hear the term demand destruction, and that's not a pretty word. Basically trying to get, people are getting a little crazy with the lockdowns and all that. Travel has really been, look at airline prices, those types of things, home prices. So yes, I mean, you raise interest rates, it affects, talk about Revlon today, filing bankruptcy. One of the biggest problems, supply chains and their debt, right? So it hurts corporations, it hurts home purchasing, which we can talk about. So yes, it will slow down the economy, and that's what needs to happen a little bit to get inflation under control.
Let's talk about your advice for these frustrated home buyers that want to buy a home. They want to get out of the rental cycle, right? A couple months ago, homes were going through the roof here in San Diego County. They couldn't afford it. Now they can't afford to get as much money to afford as much home as they would like. So what should these people do that are in the rental cycle that really do want to be a home buyer?
Yeah, well, unfortunately, it got tougher. When you have mortgage rates go from 3% to 6% in a 6-month period, I mean, that's pretty brutal. I mean, I've done this for a long time, and that's a very, high velocity change. So it hasn't made it easier. I mean, so you've seen the affordability. Affordability index is a combination of mortgage rates and house prices. And you've seen the average home price or the cost of a payment for a home is up 50% in the last 6 months.
Right.
So it's almost, I would think, a little bit of a timeout. The good news is prices will probably come down. You're already seeing price reductions. I mean, Compass Realty, one of the largest publicly traded real estate firms, just cut their staff by 10%.
Wow.
So it's happening very quickly. So
I have seen those for sale signs stay around longer in pockets and neighborhoods. Those same homes used to just fly off the roof. So it's already happening.
There's a bit of a pause, it seems like, right now. So
yeah. So if I was a first-time home buyer, I would wait and see, and so hopefully home prices come down, and rates will come down again when the economy does start slowing. But that's probably going to take a little bit of time.
And of course, David, we kind of mentioned this at the beginning, but we're coming out of this pandemic, unprecedented times. So how is that going to play a role in the way people are spending, even with this rate hike?
Well, I think the spending has continued to shifted from really home goods and home improvements to travel and leisure. That part of the economy is doing really, really well. Again, I think just this year, airline tickets are up like 30–40%, and people are still paying it. So, people have to get through that, that itch, right? Of, I want to go do and see family I haven't seen. So I think it's going to take a while for that to happen, but I think you're still going to see prices elevated for a while, especially with jet fuel cost and oil. That's a direct input cost to airlines. So that's a problem still going forward.
I know you don't have a crystal ball, but historically, how long does it take when these kind of maneuvers are made for the prices to correct themselves, things to come back down, for us to kind of get back to normalcy as far as prices are concerned?
The problem is you have such competing factions. You've got supply chain issues. China was just shut down, which is another part of our supply chain, obviously. You have the war, you have commodity prices, you have these types of things. So it's just not a straight line. We have too many things happening at the same time. So I wish it was easy. Just with markets, it takes 12 to 18 months on average for a bear market like we're in to kind of play out. So I would use that as at least a barometer for another year. That would be my mini crystal ball. Would be about that time frame at a minimum.
All right.
And David, I know we do have to go, but real quick, I got to get this out there. As far as people looking at their investments right now, if they're seeing it tank, what is your advice?
I think the biggest thing I've seen is people look for a lot of protection in the bond market, and bonds are not a place you want to be when you have rising interest rates and you have rising inflation. Bonds are down anywhere from 10 to 20%, so it's kind of insult to injury when the stock market's down 20 to 30%. So that would be reevaluate your bond portfolio. Quite honestly, would be one of the things I would look at for sure.
All right, David Reyes coming in here with your advice. Really appreciate your tips and your time here this morning.